questions on moats. Can you talk about how the different sources of moats and how that point of view has changed over time?
Yeah, it's changed a lot over time. So there's this, one of the, if I think about my journey as an investor, when I started out, I was very much focused on balance sheets and numbers and that kind of stuff. And actually, I sort of started investing properly around the time of the dot-com crash. And, at the time of the dot-com crash, a lot of the companies lost sort of 95, 98% of their value. And in some cases, they had more cash on the balance sheet than the actual value of the company. So as a sort of a rookie investor, know-nothing investor, but if the company had 100 million in cash and you could be buying it or a stake in it for 10 million, that kind of looked to me like a very good deal. So that's kind of how I started investing. And then after a while, I sort of noticed sometimes it was working really well, but other times it wasn't working at all well. And one of the reasons it wasn't working well was when the company had a sort of no competitive advantage, and even though it had a lot of cash, it was losing so much money in the end, it kind of went to zero. And so quite early on in my investing career, I kind of started focusing really a lot on competitive advantage. And when you start thinking about competitive advantage, then you come across Warren Buffett, and he's obviously talked a lot about how important it is that companies have moats and this type of thing. And so I would say it's something that I was focused a lot on. But two things have really sort of changed my mind about it. The first is I don't think all moats are created equal. So I think some moats are very positive for a business. For example, if you have a low-cost position, I think that's fantastic. Darryl described it about Trupanion earlier. The lower the costs are, the better the value you can offer to the customer, which allows you to lower costs even further. So it's a very positive type of a competitive advantage. But there's other moats, for example, switching cost, where the idea is the customer is so locked in to the company that you can basically give them a crappy service, raise prices, and whatever happens, they basically don't have any choice. They have to stick with you. And I think that's a kind of like a very negative moat because it sort of incentivizes you to do a bad job. And if you're doing a bad job, then at some point in time, the business is gonna deteriorate. So I think that was really sort of one of the first sort of insights I had about it. And then the second one I had was that I kind of realized that the world is changing so fast that by far the most important thing to look for in a company is that it has an ability to adapt, that it's sort of permanently improving itself and figuring out what the new challenges are, what the competition are doing, what the new services customers want, and responding to that and developing the business. And in the big scheme of things, is a moat, if a company with a wide moat, is it more or less likely to have that sort of sensitivity to customer requirements? And I think on average, if the moat is really, really wide, then the companies generally become complacent and fat and less focused on what the customer wants. So I don't think a moat is always an unmitigated good. So what and I wrote about this in my most recent letter, what I much prefer to see is a company which is improving so rapidly that moats are kind of emerging from that, but where the moat is really kind of the output. And so it's kind of nice to have, but what you're really looking for is the input, that sort of constant improvement, because that's what's going to drive the really long-term success.